It's August, and I've already had a number of conversations with clients about getting money out of their RESPs for their kids going back to school or just starting school this September. So with this e-newsletter intro, I want to guide you in how to make RESP withdrawals in a tax-smart way, and to also dispel a couple of RESP myths along the way. Some parents might be making their first ever RESP withdrawals after many years of savings, while others might need a little bit of a refresher of how things work. Indeed, saving in an RESP is actually the easy thing. You just shovel money in every year, you get some grants, and you go. A lot of my clients are older millennials or Gen Xers, and they've been doing this for probably the past 15, 20 years. Now, a lot of them are finding their kids are entering university. So now it gets a little bit more complicated. Years back, I wrote an RESP wiki page, which goes into all the ins and outs of RESPs. It's gotten to be quite lengthy, and I've been updating it every year. What we're going to do in this video today is we're just going to look at the part on withdrawals. So what you'll find when you go to my wiki page at nuhs.ca/RESP, scroll down a bit and you'll find a table of contents that will get you right to the area where you want to go. So we're looking at RESP withdrawals. So what helps you out is that your financial institution that you have your RESP with has already been keeping track of a number of notional balances for you. What you see on your statement in terms of your RESP balance only tells part of the story. To give you an idea, what we're looking at here is a fairly typical RESP. And usually in most cases when we're talking about RESPs, they're opened by parents who are the subscribers for their children who are the beneficiaries. They can be opened a number of other ways, but I'll just keep things nice and simple. And what a lot of my clients do in order to get the Canada Education Savings Grant into the account as soon as possible is they open an RESP for their child when they're born, or pretty close to when they're born once they have a social insurance number, and contribute $2,500 a year from that point onwards. $2,500 a year gets the maximum annual $500 CESG, Canada Education Savings Grant, and by around age 14, you will have maxed out the current lifetime limit for the grant of $7,200. So in this example, I'm also applying a fairly modest 5% growth rate to show what the effect is on the account balance. And so what we see here with this RESP having contributed $2,500 a year, receiving $500 a year of grants up until the year in which the child turns 14. Seeing a bit of growth at 5%, we see that balance grow to about $78,000 by the time they are 18. That $78,000 is made up of those notional balances as I mentioned, the capital, all the contributions combined, total $37,500, grants totaling $7,200, and then the difference between that end balance and what has gone into the plan is the growth, the accumulated income, in this case $33,622. So when you were putting money into the RESP, none of these balances really matter to you, but now that you're going to be withdrawing from it, they are very important because they determine what money is taxable and how. Essentially, there are 4 types of withdrawals from an RESP. 2 that apply when the beneficiary is enrolled as a student in a qualifying institution, and 2 that otherwise apply if they are not a student, or when you get to the point when you need to collapse the plan and you no longer have an education use for the plan. I'll start with the 2 less favorable types of withdrawals just to get them out of the way early. Now, you don't have to worry. It's not as bad as some people think it is with RESPs, that there's a chance that you really could lose a whole lot to taxation if your child doesn't go to university, doesn't have a use for the money. There are actually a lot of uses for RESP money. The list of educational programs that qualify is quite lengthy, not just universities and colleges, but various trade schools, vocational schools would qualify, as does part-time learning. So in most cases, you will find a use for the money. So it's very, very rare that I ever see an RESP get collapsed using an accumulated income payment. But just for theoretical purposes, let's go through and see what this means. The non-education capital withdrawal is money that you have contributed, that you have already paid tax on. So it's basically just you taking your capital back. So in that previous example, the $37,500 has no tax consequence. The consequence, though, if it is done as a non-educational capital withdrawal, is that the grant money that was received for those contributions gets sent back to the government. That money is lost. So that's the $7,200 out of that previous example. What's left is the accumulated income, the growth in the plan over the years. Now, if you've benefited from tax-deferred growth for many, many years, and that money is not going to be used as the purpose is for an RESP for education, the government's going to want to have some of that tax money back that they missed out on all those years. So they're going to penalize you with a 20% surtax on top of your regular marginal tax rate if you take the money out that way. So not good, but again, that applies only to that accumulated income balance in my previous example of $33,622. The subject of this video is, of course, how to make tax-smart withdrawals from RESP. So I'm not going to go into this too much more, but you can find out more about what your options are in that type of a situation by heading to my RESP wiki page. Now, it is also important to remember that an RESP can be open for quite a long time, upwards of 35 years. So even if the beneficiary doesn't plan to go to school right away at 18 or 20, they have a lot of time until potentially their late 20s, maybe even early 30s, when they could use this money for whatever educational purpose they might have. So it's a pretty long runway. You don't ever have to feel rushed. So now looking at the better withdrawal types when they're attending school, what is actually required for the student, for the beneficiary to qualify as a student and to make proper educational assistance payments and post-secondary education capital withdrawals. So the essential document that qualifies the beneficiary for these types of payments is a letter of enrollment. That letter of enrollment should show the student's name, program details, length of term, whether it's full-time or part-time, and the enrollment dates. They're fairly standard and they're issued by the registrar's office and usually on the letterhead of the educational institution. Now, a letter of acceptance is not enough. A letter of acceptance does not prove that the beneficiary is enrolled in school, nor is an invoice or receipt of tuition paid. And actually, a common myth among RESPs is that proof of payment is needed. That's actually not the case the vast majority of the time. The actual tuition costs might only come into question if a very large withdrawal is made, and usually that's just for audit purposes. Sometimes some institutions have internal policies that they want to make sure that the money is properly used for education. But usually at that point, we're looking at withdrawals of $30,000 or more when such a requirement might be made. All that matters is that the beneficiary is enrolled as a student, and otherwise the financial institution, the RESP provider, does not care how that money is spent. RESP money isn't meant to just cover tuition. It's meant to cover the living expenses of the students. And no institution is going to require the receipt for meals paid for or things like that. And that's another important thing. Withdraw more from the RESP than simply tuition costs. Sometimes I see people have RESPs that have built up to quite high balances and they feel compelled to only take out what is needed for tuition. They should be taking out significantly more if they want to wind down that RESP over a period of perhaps 4 years. When it comes to EAP withdrawals, there's only one main limitation, and that is in the first semester of school, only $8,000 can be withdrawn as an education assistance payment. If more money is needed, it can be withdrawn as a capital withdrawal. And the reason they have that limit is just to prevent parents from taking advantage of all the benefits of RESPs if their child drops out of school after only one semester. So in that first semester, the limit on EAP is $8,000. After 13 weeks, as long as the student is still continuously enrolled, there is no limit whatsoever to the EAP withdrawals. Now, when you go to make an RESP withdrawal, if you have your RESP at a bank or if it's through an online brokerage, you're often not given a lot of advice. Sometimes you might also be dealing with an advisor who is themselves not that fluent in all the ins and outs of RESPs. And while they're giving you all the options, they're not really giving you any suggestion on how to make that withdrawal. And too often I see that parents are making completely the wrong decision into how they prioritize those withdrawals. The natural inclination is to defer or avoid taxation when you can, and so that compels people to making mainly capital withdrawals first off. So again, if you're just basically given a form and it says you can take this out as a taxable withdrawal, taxable in the beneficiary's hands as EAPs are, or simply take a capital withdrawal and there are no tax consequences whatsoever, The thinking is, the simple thing is, let's just do capital now and try to defer taxation till later. And in most cases, that is completely backwards wrong. And here's where working with a good qualified financial planner can really potentially save you money in taxes and save you the stress of pitfalls later on, versus dealing with a sales rep at a bank or just filling out a form on a website. Now, the pitfall that can happen if you're making the unadvised decision of taking capital first is that education assistance payment money stays in the plan and it continues to accumulate. And the great benefit of an RESP is that EAP money not only has grown tax deferred for many, many years, but it also gets reattributed from the parents who might be at a higher tax bracket to the child who is usually at a lower tax bracket. And in order for that to work, you often have a fairly narrow window. Maybe it's 4 years, maybe it's only 2 years, during which those EAP withdrawals can be made. If the student has dropped out of school before EAPs are paid out, it may be more difficult to get that EAP money out of the plan in a tax smart way. There are a lot of other options, such as if it's a family plan, it can go to a sibling. Again, I won't get into all that today. But generally, you should be emphasizing those EAP withdrawals early on. What also can happen, a little bit less bad, is if the student is in their later years, maybe doing a co-op job and they have some extra income, that income puts them into a higher tax bracket. That also reduces a little bit the benefits of the RESP, although that's not too bad. The worst is when there's a whole bunch of money left and then you're having to do that nasty accumulated income payment that I talked about earlier. In an ideal scenario, the student has income of less than $16,000 in their first couple of years of university, and then in most provinces, they're actually paying next to nothing in taxes when making EAP payments. So while everyone's circumstances might be slightly different, in most cases, it makes the most amount of sense to be making EAP payments early on in the first couple of years of university, and leaving capital to be withdrawn later on as the final bit of money to come out of the RESP. So in the case of my example here that I mentioned previously, that means using up this grant and accumulated income payment money first. So in this case, you've got about, looks like $40,000 of taxable EAP money that the student can pay taxes on, and then later on take that $37,500 out. What that means is in that very first semester, the maximum $8,000 should come out as EAP. That EAP will be a certain mixture of grants and accumulated income. And then in the second semester, from the second semester onwards, you probably will be wanting to do entirely EAP or a reasonable amount, again, based on if the child already has some taxable income. Keep in mind, though, too, as you're withdrawing money from there will be continued growth in the RESP, or there potentially can be while the student is in school. So that accumulated income might continue to go up even if you were to drain all of it. The remaining capital will still grow, and that growth gets added on to the AIP balance. But in any case, realistically, you should be able to get most of that money out of the plan within the first 2 years, latest in the third year, and then in the fourth year, you can then drain down the capital. And just keep in mind, this is the important money that you'll want to be taking out of the plan, and you may only have 2 years to do so if, for example, your child drops out after 2 years. You don't have to necessarily spend it all on education. That money can also simply be taken out of the RESP and put into a different investment account, or maybe a TFSA, or gifted to the child for later years. It's just a matter of getting the money out of the RESP during that short window. So anyways, I tried to keep this video under 20 minutes again. There's a lot more I can tell you about RESPs, one of my favorite subjects. Again, I'll direct you over to my wiki page for more information. As you can see, it is a fairly lengthy blog that covers everything from a warning about group RESPs, basics of RESPs, the various grants and how they work, how they're accumulated in the plan, some options for low-income families, who and how to open an RESP, how family RESPs work, various contribution strategies beyond the one I mentioned in my example, what you can potentially expect education to cost, how to invest in an RESP, and again, the section RESP withdrawals, which also talks about, in the withdrawal scenarios, of what other options are there if the money isn't used for education. There is also a podcast that Justin and I recorded a few years ago on this very topic. And if you're looking for any of my other wiki posts and other resources on my website, muhs.ca, there's a resources button where you'll find these resource posts for TFSAs, RIFs, RESPs, spousal RSPs, FHSAs, and other things that you might find something useful there, as well as a lot of other useful resources, including the RESP page from the Canada Revenue Agency, and other resources. Please, if you found this information useful and this video informative, like it, subscribe, comment, share it with a friend. And if you want to receive my totally free monthly e-newsletter, which includes my latest content like this, as well as a lot of other good stuff that I read over the course of a month that I find is useful for anyone who is looking to be informed about the markets or Canadian personal finance, subscribe at muhs.ca/newsletter. Once you've subscribed, if you want to get the latest issue, simply reply to the first email that you get and ask me for the latest newsletter, and I'd be happy to forward it to you. Thanks for watching.